Good afternoon, Peter Klein, Chief Investment Officer, co-founder of ALINE Wealth, with you this afternoon of the 29th of October. And we had a Fed decision earlier today, and we had a very well-known AI stock reach the highest valuation, market cap valuation in history. So exciting day. Allow me to walk you through how we're seeing the economic and market environment late this year in 2025, and what that might mean going forward for 2026. You remember, it's not our job to essentially operate at current time, but essentially to think about how the future market activity and conditions might impact our clients who we are charged with servicing and making sure that they always stay away from risk. So allow me to share the screen, and from there we will go to our presentation. So bear with me while I do that. Here we go. Number 2. Okay. All right. So at this point, you should be able to see our typical ALINE Wealth winding road. And the background to that is at ALINE Wealth, we aim to connect our clients from the start to the finish to allow them to easily navigate the twists and turns in the financial lives and markets. And that's a good way to start today's conversation, because we're not going to just talk about the current market environment this afternoon. I want to start off with a discussion about wealth management. What does a wealth manager do? Folks, we are in the people business. We are not just investors. We're not just in the capital markets, although clearly we put our life's work into doing that. We have a higher standard. We have to deal with Mr. and Mrs. Jones, the clients on the other side of the table, and make sure that their assets are protected, to keep them out of harm's way, to make sure that they don't make decisions that are potentially risky or outside their risk tolerance because of the market conditions and the media and all that's going on in the world pushes them in that direction. We're that opposite soundboard, that what if. And that's what our job is to maintain that high standard of fiduciary-centric advice and always putting the client's interest above all else. We are not gunslingers. We're not just portfolio managers. We are compounders of wealth and managing clients' expectations and managing their plan going forward. It's an important distinction. This is the what is wealth management equation. We've spoken about this before, whereby we look at what is wealth management. We break it down into 3 components. The first, of course, is investment consulting. I'm in no way, shape, or form suggesting that a good wealth manager ignore investment consulting. It's the lifeblood of what we do in wealth management. Yes, we have to, make our clients appreciate their assets over time. Yes, of course. I'm just simply saying, in this somewhat extended bull market period right now, another very important part of our work is communicating and making sure we keep our clients on that road to success rather than hitting against guardrails, owing back to our twisty turning road of before. Of course, advanced planning and wealth enhancement and making sure that the estate planning is done and making sure titling is done properly, protecting the assets. And of course, as I mentioned earlier, the importance of relationship management, communicating with our clients often and upon request whenever they need us. This is the wheel. That is what we call it here at ALINE Wealth, the wheel. And it shows you that this is a defined process. Wealth management is simply not just something you're investing people's money. It's more than that. It's a lot more than that. It's listening, understanding who that client is, what they do, what makes them tick, what's their worries, what's their fears, what's their aspirations? How about their kids? How about their legacy? How about the cash flow they need to live their lives? How about their health and how that impacts with the decisions we're making? All of this rests on our shoulders. It's a high standard, but one we embrace as our life's work. This is what we do as wealth managers. So a defined process, that's the point of the wheel. Proactive empathy is a term we use at ALINE Wealth. It is one of our mantras, essentially meaning that we're always thinking about our clients. We're always thinking about what they should, we don't want them worrying about. We want to be that person doing that worrying, that thinking, that modeling, that concern. Let's figure it out. Let's make sure we checked it out. Let's make sure we're looking at any implications to their cash flow needs, develop different plans and models and the such. And to that end, we are always looking to make sure that our clients are in agreement or at least aware of what our thinking is. And of course, there's always discussions and debates. We're always open to new ideas and new thinking. But as seasoned wealth managers, we've seen a lot. And frankly, this is a very important time. This is why we're doing this call today. That's a little different than our usual monthly call. We're at a time now when there's a lot of excitement, much of it to do with artificial intelligence and the companies surrounding it. And we're here to say it is our job to find the investments that make sense for our clients, not just the ones that are hot and sexy, if you will, and in the media. That's not what we do. That would be simply somebody who's a novice. We have a higher standard, which requires us to do the heavy lifting of analysis, to ask those questions of what can go wrong and how can it impact and how can I protect my client, our clients, and their cash flows. So communication is critical. We like to use technology. We are in no way, shape, or form a Luddite firm. We like technology. We use technology. We use it to make sure that our experience with our clients are excellent. And Black Diamond is that reporting software that we use to maintain our clients so they know exactly what is going on in their account and in their portfolio and the exposures and the performance. Okay, so with that behind us, clearly there is a lot going on. I want to get into it with you. You know, the Financial Times ran a piece this week that was very interesting. They talked about good bubbles and bad bubbles, suggesting that there are, and some very smart thinkers are saying this, that there are bubbles that are good, like railroads and radio back in the day, and I guess you could say steam engines before then and cars after, and all of this was positive, right? Think of the internet. But what they're missing in that discussion of good bubble, bad, and well, by the way, bad bubble is financial leverage, like say Japan in the 80s or the mortgage crisis here in '08. But going back to that concept of what a good bubble might be. And I understand the importance of having a new technology and what that brings to the table for society. I get it, and I'm all for it. But again, going to that standard of care, we have to be mindful of all those bubbles, railroads, radio, TV, all the internet, and now perhaps what we'll see here in AI, they had a downside, a pretty substantial, difficult, heart-wrenching. Some portfolios got imploded. This is what happens on the other side of the bubble. So while they might say, again, a hedge fund manager, portfolio manager, someone who's not working with the end node, that client, and having to report to that client, they may say, yeah, bubbles, technology bubbles are great. Industrial bubbles are great. They're missing the other side of a bubble, the pop. And we're aiming to avoid the pop, because we can't allow our clients to have that happen to their portfolio. Right? That drawdown is too painful, especially if you're using the capital in retirement to live. Now you have a portfolio's assets have come down, plus you're spending the money. No bueno. Not going to work. Not on my watch. So let's move forward. Cash is good enough for Buffett. It gives you an idea of where Mr. Buffett's cash is at Berkshire Hathaway. So, that's where we're at. Most of our portfolios have substantial cash as a proxy for fixed income. We still believe that inflation is a risk and therefore believe that it's best to have cash parked rather than intermediate bonds, short-term bonds notwithstanding. Concept of U.S. exceptionalism. Wonderful, great, exciting. As you can see here, the U.S. stock market, which, by the way, if you look at the earnings contribution of the U.S. stock market to the world, it's like a third, maybe 25, 28%. Yet it's 50% of the market cap. Interesting. And if you look at what happened in Japan in the 80s, they had a wonderful run as well. Everything was Japanese, in the 80s. And in 89, it topped 40 years. Japan is just now getting interesting from our lens. But for 40 years, it's done nothing but go down. So this is what happens. Price gets too high. Multiples get too rich. People become too complacent. These are the signs. It's our job to balance the balance. Here's another valuation stat that's very troubling, at least to my eyes. We're at the all-time high price to book ratio. Book ratio are the assets of a company. Okay, I understand the intangible asset factor of this new last 25 years technology run. I get it, but still. 5.4 times seems a little robust. And if you want to use earnings rather than book value, there's some good examples of different types of valuation metrics here from the PE over 10 years, 117% above its mean. So you get an idea of what's going on here. Things are richly priced. And if you didn't think that valuations matter, and they don't matter typically in the short term, right? Because there's a lot of noise out there. Remember the old adage, in the short term, the market is like a voting machine where everybody's input makes the difference. But over the longer term, it's like a weighing machine where the empirical evidence makes the difference. That's a critical distinction. Going forward here, if we can, the top 10 weights in the S&P, as you can see here, versus its earnings. You can see how it's a bit of a disconnect. How about AI? Let's talk a little bit about AI. I think this is a wee bit overdone. These companies these are all private companies, so I could show them here. They're not stocks, but you can see the valuations are really off the charts, literally off the charts. And here you have a return by the price to sales tranche. So these are companies that are trading at 20 times or more price to sales. That is ridiculous. That is unsustainable and non-fiduciary centric. You don't buy stocks that trade at 20 plus to sales. It's going to blow. It's going to blow off. It's not going to work. It's not the way we invest. There are plenty of companies that are down here that we could perhaps look at. But when we're getting up to the stratospheric levels, it's just too much risk. You're paying too much for entry. And we don't think that's the way to invest. There are plenty of other better ways with less risk. Looking at inflation pressures, as I previously mentioned, this is just one of the 3Ds that we have mentioned before, that it will give us sticky inflation. And we think decarbonization efforts are part of that. Add to that all the build out with AI and deglobalization efforts around the world. This is why we think inflation is going to continue to be sticky. You've spoken about the interconnected tissue of the AI. I blocked out the names of these companies. You can figure out which they are. Just shows you the spaghetti of, the bowl of spaghetti that is these companies, and it does give one pause. And one of the biggest concerns I have about AI is obsolescence risk. Do you realize how many engineers and graduate school engineers, brilliant people, are outside of our country? You can see the graduate levels here. You can see the numbers here from India and China. Don't you think they're working on AI? What's going to happen one day we wake up and we have another potential product out there, or a better product? That worries me. That's the big problem with technology is the obsolescence risk. And unless you think it can't get ugly, I remind you that markets can get ugly. We didn't have much of that earlier this year. We had, I guess we doesn't even make this page, how little it was the first couple of months of this year. But as you could see, there were periods of time, I guess you go back to 2020, the pandemic, there was only 17 days in a row when the market fell below 20% of its record high. But as you could see here, there have been many a time, although it's distant memory, these are a bit more current memory, markets can go down. And we are priced to perfection here. So it gives one pause. Doesn't mean we pull out. It means we balance. We move more towards cash, move less towards risk, wait it out a little bit, do so tax efficiently. This is what we do. On the opportunities front, I do think small caps have some opportunity. You can see here how they're currently traded on these different metrics versus the S&P, and massive discounts to the S&P. So we think that these smaller companies, US based, less tariff issues could certainly make, and less technology weighting could certainly be opportunities. I mentioned Japan earlier. I think it's certainly an opportunity. It's turning. We have positions there. You can see this is a 35 years from 89 straight through before they had a new high. Could you imagine that? Now, why did it happen in Japan and not happen? It can't happen here. I mean, it did. We go back into depression, but that was a long time ago. I'm not suggesting it's happened. I'm simply saying we've got to be aware of it. We've got to be mindful of it. This is not a game. This is someone's life savings. These are assets that are entrusted upon us as advisors, as wealth managers, to protect those assets and to grow them. Let us not forget the first part of our dual mandate. On a call to action, under that protection mandate, we have a program called Riskalyze at the firm. We could answer some questions with you, and we determine what your risk score is. And from there, we can determine your portfolio's risk score. I urge you to take advantage of this. We're happy to do this for you to get a sense on where your portfolio is versus your risk tolerance. So with that, let me stop to share. Wish you all a happy November. A happy Thanksgiving early, of course, although it's late this year. And I do look forward to further conversations. Please reach out to us with any discussions, any questions, any comments. We're here to serve. Thanks very much.